All right, welcome to The Explainer. Today, we are diving into a really fascinating puzzle from the world of finance, and it's all about a company called FactSet. They're a major player in financial data, but lately, they've been sending some seriously mixed signals to the market.
So let's get right into the mystery at the heart of all this. Look, by just about every measure, FactSet is a fantastic, high-quality company. But for some reason, its stock is trading at a steep discount. The big question is, why? And that's exactly what we're going to try and figure out today.
And this slide right here shows you the core conflict that's got investors so spooked. On the one hand, you've got healthy revenue growth, which is great. Sales are going up. But on the other hand, profit growth is shrinking. So that disconnect is really central to this entire story. Okay, so to crack this case, we have to start by looking at the evidence. And the first clues, well, they're right here in the company's latest financial results. So let's dig in. First up, the good stuff. The top-line numbers, they look pretty solid. In their second quarter, FactSet's revenue grew by a really healthy 7.1% compared to last year, hitting $611 million. That is exactly the kind of growth you want to see. But, and this is the big but that's causing all the anxiety. During that exact same period of strong sales, the company's net income, the actual profit, it fell by 8.1%. So you've got more money coming in the front door, but less of it is actually hitting the bottom line. See the problem? But hold on, the plot thickens. Check this out. Free cash flow, which is the actual cash the business is kicking off from its operations, it surged by over 23%. This tells us the underlying business is still a cash-generating machine, which just adds another confusing layer to our mystery. This visual really nails that profit squeeze we're talking about. The company's operating margin, which is basically how much profit it makes on each dollar of sales, it's tightened up. It's dropped from making 32.5 cents on the dollar to just over 30 cents. Now that might not sound like a huge number, but that downward trend is exactly what has Wall Street on edge. So what is the real story here? Is the company's business model broken or something? Well, it turns out this isn't an accident, and it's not a sign that the business is in decline. No, this is a deliberate, absolutely massive strategic bet on the future. The reason for that profit squeeze comes down to one thing: AI. FactSet is pouring huge amounts of cash into artificial intelligence. The goal here is to build a deeper competitive advantage, what some people call a moat, by getting its advanced AI tools so deeply embedded into their clients' workflows that leaving becomes almost unthinkable. And believe me, this isn't just talk. They are all in. They've created a brand new C-suite executive role just for AI. They're partnering with the heaviest hitters in the tech world. We're talking Snowflake, Databricks, and Anthropic. And they're already rolling out new AI-powered products that clients are adopting at an incredible clip. Now, this is absolutely crucial to understand. The company's management is essentially telling investors, hey, everybody, calm down. This isn't a problem, it's a plan. They see this spending as a temporary investment phase to fuel much bigger growth down the road. It's a classic case of short-term pain for long-term gain. Okay, so before we can judge whether this huge AI bet is a good idea, it is so important to understand the rock-solid foundation that it's all built on. This is not some desperate gamble. This is a strategic move made from a position of real strength.
I mean, FactSet's core business is an absolute fortress. Just think about these numbers. Over 95% of their subscription revenue gets renewed every year. 91% of their clients just stick around. They serve almost all of the world's top asset managers, and they do it in an industry that's incredibly difficult for new competitors to break into. And this right here shows you just how sticky they are with their customers. A stunning 86% of their top clients are using 5 or more of their different solutions. I mean, just imagine the massive headache it would be to switch to a competitor. That stickiness is their superpower. It gives them a predictable, reliable stream of revenue year after year. All right, so you have a really strong core business that's funding a big, expensive bet on the future. So how does all of that come together in the company's stock price? This is where that whole idea of price versus potential really hits home. Well, no matter which way you slice it, the numbers seem to be screaming that the stock might be undervalued. All these different valuation models, which are just fancy ways of estimating a company's true worth, they all point to a higher price. Even a simple metric like the price-to-earnings ratio is way, way below its historical average. What that tells you is the market seems to be almost entirely focused on the current profit dip and maybe not the potential future growth.
It's interesting. If you run FactSet through a kind of simplified Warren Buffett-style checklist for high-quality companies, it passes with flying colors on almost every single count. It's got a durable competitive moat, trustworthy management. It really does look like a classic high-quality business.
But, and this is a really important but, this is not a slam dunk. The market isn't being cautious just for fun. For anyone looking at this, the story isn't just about the opportunity. It's about balancing that against some very real risks. First and foremost, that massive AI strategy, it might not deliver the returns everyone is hoping for. That's a huge risk. Second, their competition is incredibly fierce. We're talking about giants like Bloomberg, who are also pouring billions into AI. And finally, the company itself disclosed an internal control weakness in its filings, and that's definitely something you'd have to monitor closely. And so that brings us right back to where we started. But now it's really reframed as the ultimate question for any investor, isn't it? Is the market right to be this cautious? Is the current low price a warning sign of deeper problems? Or is it a rare opportunity to buy a high-quality company at a serious discount, just before its biggest strategic bet really starts to pay off? The answer to that question is the key to solving the entire FactSet puzzle.